Assalamu alaikum. Welcome to video 35, IFRS 15, which is revenue from contracts with customers. This is a major standard which is often asked in SBR and as well as FR. So IFRS 15 is also a standard which is 100% going to come for your exam. So in this standard, there are 5 steps to recognize revenue. First, you have to identify the contract. A contract is an agreement between two or more parties that creates rights and obligations. Second, identify the separate performance obligation within the contract. Performance obligations are promises that are made to a customer. Third, the transaction price. The transaction price is the amount that entity expects to receive in exchange for satisfying their performance obligation. Amounts that are collected on behalf of third parties, such as sales tax, are not transaction price. They are excluded. Fourth, allocate the transaction price to the performance obligations in the contract. If there are more than one performance obligation, transaction price you have to allocate between the performance obligation. And finally, you have to recognize revenue when you are satisfying the performance. So you can satisfy the performance over a period of time or at a point in time. If you are satisfying over a period of time, you will recognize the period over a period of time. And if it's at a point in time, you will recognize the point at a point in time. Okay. So for each performance obligation, it's very important to decide whether the performance obligation is satisfied over a time or at a point in time. Now, recognize revenue when you are satisfying. So this is for over a period of time. Okay, if one of the following criteria is met, you will recognize revenue over time. First, where the customer is simultaneously receiving and consuming the benefit as the entity performs. For example, right now what I'm doing, I'm teaching you. So as I'm teaching you, I'm receiving the benefit. So this is a service that I'm giving you. Okay, so when I recognize the revenue, I will recognize it over time. Second, entity performance will create or enhance the asset. For example, work in progress. Okay, any asset that takes a long period of time. Okay, so while they are in the work in progress, you will recognize the revenue to the portion how much they've covered. For example, I've covered 60% of my work. So the revenue also I can recognize only up to 60%. One example is creation of building. When you construct a building, so as long as you start working on it, it will enhance the use of their asset. Okay. Third, entity performance does not create an asset with an alternative use. There is not an alternative use. You cannot sell it to another party. Okay. Entity has an enforceable right to payment for performance completed to date. Okay. So entity will have the right to receive the payment to whatever work they have completed. If they, let's say they have completed 60% of work, so they will get the 60% of amount, which they will recognize as revenue. So any of this criteria is met, your performance obligation is satisfied over a period of time. Therefore, your recognized period also over a period of time. Coming to performance obligation that is satisfied at a point in time. Okay. So you are recognized at a point in time. This is easy. This is when the control passes to the customer. And mostly for goods, it is performance obligation at a point in time, and for services, it is over a period of time. So for at a point in time, the most important is you have to see the date when customer is obtaining the control of the good. Now, let us go through an example. So A company is entering into a contract with B to construct a building. Construction started on 1st October. The contract price was 4 million plus a bonus of 1 million that would be payable if construction is completed by 30th September. Building has been specially designed for B and it cannot be sold to any another entity without modification. A believes that it is more likely than not that they will meet the bonus criteria. Okay. Now, so the terms of the contract specify that B must pay A within 30 days of the end of each quarter based on the progress. A measures their progress as a proportion of total estimated contract cost. So the total cost is 2.5. If B cancels the contract, it is liable to pay A for the work they have completed. So by 31st December, A has incurred cost of 0.5. So the estimate of the total cost will remain unchanged here for the contract. Although the progress on the contract has been satisfactory, there is still doubt whether that 1 million bonus will be received or not. Okay. Now, so what is the accounting treatment? A has entered into a contract with a customer. Okay, it's very clear that there is a contract that they have entered with a single performance obligation. What is the performance obligation? To construct a building. Price is also fixed, the transaction price, which is 4 million. 4 million is a fixed consideration, 1 million is a variable consideration, that bonus part. But the variable consideration you can only include in your transaction price if it is highly probable that it will not be reversed once the uncertainty is known. So due to the bespoke nature, you see the nature of the building is very unique. So there are doubts. So because there are doubts, variable consideration that 1 million should be excluded from the transaction price. You cannot take it as a part of transaction price. So your transaction price will remain at 4 million only. Okay. Now, revenue. Let us come to the fifth stage, recognition of revenue. So we have identified the contract, we have identified the performance obligation, we have allocated the transaction price, we have allocated the transaction price to the performance obligation. Now the last stage, recognition of revenue. So the revenue should be recognized over a period of time or at a point in time. Over a period of time. This is a construction of building, it takes a time. Okay. So A is creating an asset with no alternative use. It has right to payment for performance completed to date. Therefore, according to IFRS 15, they will record it over time. So the amount you have to write. So for performance that is satisfied over time, revenue is recognized based on the progress. Okay. So it is 0.5 divided by 2.5, the total cost of the contract versus 0.5, which is 20%. So you will recognize only 20% of the 4 million. That is your transaction price. So 0.8 million. This is your revenue. So A has to show a corresponding receivable of 0.8 because it has an unconditional right to receive this money. Okay. Now, example of a non-refundable deposit. So Flight is an airline which sells flights directly to customers via a website. Flight must pay for in full at the time of booking and flights are non-refundable. So what happened here? Flight has entered into a contract with a customer. That is single performance obligation, that is to provide a flight. And in this case, it is satisfied at a point in time when the flight has been taken. So they will recognize once the flight has been taken by the customer. Now, from the exam kit questions, these are the questions you have to do: ZTech, Cartoon, Sitka, Chassis, Ruble, and Calibra. Thank you for watching, and I shall see you in the next video, that is IFRS 16 leases.